Why cheap stocks aren't always good? The biggest investing trap. Imagine you go in a mall and there are two t-shirts. One is priced 300 rupees and the another is 3000 rupees. You immediately think the 300 rupees is cheaper and the 3000 is expensive. What if the 300 rupees fades away after one wash and the 3000 rupees lasts for 10 years? Which one was actually cheaper? The stock market works the same way. You think the 20 rupee stock is cheaper and it will become 200 one day. Today, I am going to show you why this thinking destroys wealth. And by the end of the video, you will never look at cheap stocks the same way again. The biggest mistake. You ask one question, which stock is cheap? Instead, you should ask, which business is valuable? There is a huge difference. A 30 rupee stock may be expensive. A 3000 rupee stock may be cheap. Price tells you nothing. Business tells you everything. Imagine two houses. One is 30 lakhs and other is 3 crores. Without looking inside, can you tell me which one is cheaper? No. Because you need to know the location, quality, rental income, future value. Stocks work the same way. The Vodafone Idea story. Vodafone Idea is one of India's favorite cheap stock. When the price was around 10 rupees, everyone said, how much lower can it go? They bought more. It became cheaper. They bought even more. Years passed. The company struggled with debt, competition, and profitability. The stock stayed cheap for years. Many investors kept averaging down. A low price does not guarantee a better investment. The lesson, weak businesses can remain cheap for years. The Yes Bank lesson. Yes Bank was once one of India's fastest growing bank. People loved it. Then problems started arriving. The stock crashed. People started saying earlier it was 300 rupees. Now it is 20 rupees. What a bargain. They believed that the old price would return. But businesses change. Management changes. Financial health changes. A stock doesn't owe you a return to a previous high. The market looks forward, not backward. Penny stock psychology. Why do you love penny stock? Because of one dangerous sentence. If it reaches 100, I'll become rich. But ask yourself, why should it become 100? Is profits growing? Is revenue increasing? Does it have a competitive advantage? Or are you simply dreaming? Hope is not an investing strategy. Expensive stocks that were actually cheaper. Now let us look at some successful businesses. First, Titan Company. People said the stock is very expensive. Years later, the stock became even more expensive because the business kept on improving. Asian Paints. You kept on complaining about its high valuation for years. The company kept on increasing its revenue, profits, and market leadership over a long period of time. Nestle India. It rarely looked cheap. A high quality business often commands high valuation because investors expect consistent earnings. A wonderful business can justify a high price than a weak one. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Think about that. Cheap businesses stay cheap. Great businesses create wealth. The goal isn't to buy a cheapest stock. The goal is to buy best businesses at sensible prices. What should you look at instead? Instead of asking, is this stock cheap? Ask, is the company making consistent profits? Is the revenue growing? Is debt under control? Does it generate healthy cash flows? Does it have a trustworthy management? Will this business be stronger 10 years from now? These questions matter much more than the stock price. Remember this forever. A 20 rupee stock is not automatically cheap. A 5,000 rupee stock is not automatically expensive. Price is what you pay, value is what you get. Great investors do not buy cheap stocks, they buy great businesses and let time do the heavy lifting.